Hi, this is Steve Hutchinson with Hutchinson Family Offices, and I want to give you our July video update. So let's talk about a few things that occurred last month. Well, first off, Brexit. Just a very volatile period in the market. I think somewhat was being used as an excuse for volatility. As we have said all along, we believe that the volatility in the markets will continue. And we also don't believe that Brexit will have any lasting economic impact either on our financial markets, our companies, neither that of England. Let's go further a little bit more. Let's talk about the employment numbers. Last Friday, there were about 237,000 jobs. Wall Street greeted that with a very strong rally, but frankly, we're still a little bit disappointed. Numbers that I take a look at are mostly what we call trends in employment. And when I look at the 12-month trend, I see average job growth being about 175,000 jobs a month. Right now, in the last 3 months, we've been averaging about 147,000 jobs a month. That means that we're generating jobs on average below our 12-month average. This is a slowing in the job market. This is going to continue to put pressure on the Federal Reserve not to increase interest rates because the economy cannot grow unless we're up around 175 to 200,000 jobs being created in our economy per month. Last month, portfolios got a very, very strong boost. We saw very good returns in the S&P 500, but when we look at the S&P 500 year over year, we're looking at about a net return of 2 to 3%. Most investors are probably lucky to get that because very few investors are 100% invested in the S&P 500. So we're still very cautious about the financial markets. We believe that the volatility will continue throughout the summer. And taking a look at some of the political issues that are going on, as well as social issues in our country, I would not be surprised to see even greater variations in that volatility. Finally, let's talk about interest rates. Interest rates for the most part right now are artificially low. The Federal Reserve has placed themselves in a situation it's very difficult for them to increase interest rates. We're not seeing our economy grow. We're not seeing the GDP numbers come out that we need to see in a recovery. We're seeing a declining employment market. It makes it very difficult for the Federal Reserve to start raising interest rates. So we're going to stand by our prediction that we don't really believe that at this particular juncture we will see an increase in interest rates for the balance of this year. Overall, again, I want to remind you that volatility is a concern in all portfolios, and if you believe this volatility is something that you need to take a look at closer on your individual basis, please give us a call. That's it for this month's video, and thank you.